Welcome back on the channel. On today's program, we're going to talk about predicting the stock market crash that's coming. Hi, I'm Gerald Markwith. I'm a certified financial planner. I've been in the industry about 30 years, and we dedicate this channel to those 50 and under for things you should have learned in high school and college, but for whatever reason, they didn't teach you. So let's get into this subject about a stock market crash. Obviously, if you look at videos and listen to the news, the idea of a stock market crash is considered inevitable. It's going to happen, they say. And it could well happen as far as markets go. Let's define a little bit what we mean when we say a stock market crash. It would be a sudden decline in the markets of 10% in a matter of just a few days. Now, generally, a 10% decline over a period of time would just be considered a correction. 20% from all-time highs would put it more into bear market territory. But an actual crash involves panic and a steep decline in the stock market. As an example, back during the COVID crisis, in the month of, I think it was March, in fact, of when it occurred, the market was starting to drop like 25-30% under the great fears of a worldwide pandemic. Of course, that got stopped fairly quickly when the Federal Reserve stepped in, and of course the discussion about a vaccine was talked about. But let's talk about a stock market crash. Can it occur? And if so, when? There's little doubt that by historical standards, the stock market's at record highs. You can look at almost any metric you'd like, and you'll see the markets are, well, actually very, very extreme in certain valuations. But does that mean you should get out of the market and expect a crash to happen at any moment? Well, certainly many people have called for this sort of thing, and many people have called for a crash for the past several years, and nothing has happened. This recalls the famous quote from John Maynard Keynes, who said about the stock market being irrational longer than you can stay solvent. And he's exactly right. The markets can be irrational for long periods of time. The real secret to this question is that while people can say the stock market's going to crash at any given moment, they don't know when. We could be talking tomorrow, we could be talking a month from now, or we could be talking 10 years from now. We just don't know. Now, having said that, you want to consider that what happens in a crash, if you will, is a great deal of panic occurs for whatever reason it is. In the 1929 crash, it was attributed to things like margin debt and things of that nature. But you do realize that by 1932, the U.S. was recovering until the Federal Reserve decided to raise interest rates, and unfortunately, we stayed back into the Depression. You may not know that in the early 1920s, the U.S. had another depression, also known as the Forgotten Depression. That lasted about a year or two. The Federal Reserve took no action at all, and the markets recovered, and the economy was just fine. You fast forward to other events that have taken place over history. 1987, we had a huge decline in the markets, and certainly that was a big one. We were falling 22%. And then, of course, you've had other mini declines and crashes along the way. What's interesting to note about these crashes, if you will, is that they were great opportunities to buy into the stock market. In other words, when the market goes down, that isn't a signal to sell, it's a signal to buy. But many investors shy away. They get very concerned about what's happening in the world. And it doesn't take very much to start a trend, if you will, about that. Now, we could pick lots of different areas in terms of the economy of today. We can have, of course, the famous discussion that AI is going to take away 40% of all the jobs in America. Yeah, maybe it could happen. But on the other hand, what jobs will they create? That doesn't get talked about a lot. Keep in mind that just because something goes down doesn't mean it's going to stay down forever. If you go onto chat rooms, which I don't recommend, or even look at the papers, you're going to endure what's called FUD, F-U-D, or fear, uncertainty, and doubt. And that's the way in which they try to get investors to sell their shares at a cheaper price because they're just plain out afraid. And so here you're going to have to check your emotions. You're going to have to stop looking at the media and start thinking on your own and say, what's really going on here? Anything can happen in the markets. Anything's possible, but what's probable? So let's rehearse that for just a moment and play that out. The more recent time of decline in the markets happened during COVID. The market, as we said, went down quite a bit. So what happened there? Well, the Federal Reserve and government stepped in with a huge amount of money, a wall of money, trillions of dollars, to make sure the economy would stay on track. And sure enough, it did. And of course, everyone started getting checks in the mail, and we all know the story about what happened there. So it seems as though that the markets are expecting that the Federal Reserve would step in if such a major crash began to occur. And that certainly seems to be very popular. If you look, for instance, at the great financial crisis of 2008, the same thing occurred. The Fed immediately lowered interest rates to near zero, and they did that for a long period of time, to make sure the economy would not totally fall out. It took a little while for the markets to recover, but they did, and we are here today at all-time record highs. We also have record debt, not just U.S. debt, but even personal debt and corporate debt. Margin interest, which is where people borrow money against their stocks, is at a record high. We'll talk more about that in future videos. But keep in mind that the idea of a stock market crash will probably occur sometime, at least in your lifetime. And what are you going to do? Now, one thing you could consider is, if you're really very concerned about this, is keeping an amount of money to the side, just in a money market. And that's really more of an opportunity fund, that if the market does significantly go down in a short period of time, you can take advantage of it and buy stocks at a much lower level. By the way, that's what Warren Buffett has done. He's got about $350 billion just sitting out there in treasury bills, expecting the markets to revert back to a more average level. Now, he may be waiting a while. He has been waiting a while, and it may very well occur. But the problem is nobody knows. It's easy to make a prediction like this because people forget a long time about what you even predicted. In other words, if you're going to make a prediction, make it as often as possible, because in the end, who knows? Now, whole careers have been actually formed on just making one right call. In the case of The Big Short, Michael Burry made a lot of money and was, of course, received a lot of accolades and fame for saying that the markets were heading way down. Others have done that in the past. They've been right within a short period of time, and they come out looking like geniuses. But that geniuses don't last all the time because the markets are very complex. No one really knows what's going to happen from day to day or minute to minute. Now, it's easy to make predictions if you like being wrong, because most of the time you will be wrong. Most of the time, the things that you fear the most never happen. In fact, I saw a study one time that said 99% of the things you worry about will never occur. That doesn't stop people from predicting things and claiming they're going to be right. Now, if you predict a stock market crash over, say, 10 years, you might be right. If every year you get in front of the cameras and say, the market is going to head down from here and it's going to crash, and you're wrong, you do it the next year and the year after, well, pretty soon people will ignore you. Or, the very time that it does happen, they'll say, what a genius. But you missed out on 10 years of growth and profits. So I realize that in discussing investing, you're very hesitant to want to invest money in this market. This market is a very, very volatile market, very expensive, and anything seems to occur. You don't really know the direction of the economy. We don't know anything about the course we're going to take. We look at what's going on currently in Iran. We look at the oil situation, AI. I mean, pick your subject. All of them are of some concern. So in making your decision, you may want to consider investing, but not all of it at once, but dollar cost averaging into the market. And by that, what I mean is that you invest your money and say, if the market declines 5 or 10%, you put some more money in. The market goes down another 5% on top of that, you put some more money in, and you dollar cost average for long-term growth. I'm not an advocate of short-term trading. I think that if you're doing a short-term trade, you may very well make some money at it, but it's extremely difficult. Rather, if you stay the course long-term, you should benefit from the growth in the economy and, of course, of the world in general. But think about what we're talking about here. We're talking about panics, people worried, and the first thing they do is get out of the market, when in fact, they should be looking very closely at it to see what opportunities are actually there. Obviously, I've had clients call in very concerned, and at times I've had to talk people off the ledge. But in the far-looking ways of looking at this, the market is going to reward you more than not. If you look at the history of the country, that's true. If you invested money during the Great Depression and waited it out, you would have made money. Now, for sure, it'd have been volatile, and you wouldn't always have a positive return every single year. But over the long term, as we've talked about before, the general market has averaged about 10% a year, including dividends. So your goal here should be to participate in a growing economy. The Federal Reserve has certainly no desire to see the market go down. The president or Congress or any of the politicians, especially those running for office, don't want the market to go down. And so if you stop and think about it, the odds of a major crash get smaller and smaller. That doesn't mean it can't occur. Anything can happen. But keep in mind the probabilities rather than the possibilities. The probability is that the markets will go higher. And when I say go higher, I don't mean that they jump 10% in one day, but they, over time, gradually move to higher levels. They will dip at times. They'll come back. If you buy mutual funds or index funds, you're diversified better. If you own an individual stock or stocks, you might want to look at those more closely. But again, there's risk in everything we do. Everything in life is a degree of risk. You can mitigate it to some degree, but you can't escape it. It's there the minute you wake up in the morning. So I hope this is hopefully a discussion that we're having that you consider very strongly. Don't listen to every person that says things, whether good or bad. In other words, you want to be having a critical thinking experience by asking a lot of questions. What if this occurred? What if that occurred? What are the probabilities of those things occurring? These are all fair things to consider. Panic is not a good strategy. If the markets do go down, and they have in the past, panicking out of the market, selling out at any price, is not a good strategy. I'll give you an example. Back in 1987, where I was working, this is the time of the big crash that occurred during President Reagan's time. The market was declining rapidly, and they said the price quotes were running 4 to 5 hours behind. In other words, if you put your sell order in, they couldn't tell you what price you were going to get. Now, as crazy as that sounds, people did that. They sold their stocks without even knowing what price they're going to get. And of course, they paid the price for that as well. But again, if you take a more rational, calm approach to the markets and you see the panic for what it is, just strictly people not even thinking, you can benefit from that long term. Now, again, am I calling for the stock market to crash? I'm sure at some point in time, something will happen that might cause that. I can't rule it out, nor will I rule it in. I can't tell you when. They can't tell you when. But stop falling for the idea of fear, uncertainty, and doubt. Oh no, the power went out. Who could have predicted that? Here I thought everything was going just fine, and suddenly everything's ended. It all got dark. That's a little bit like what a stock market crash is. It's the unexpected, things that you aren't looking for, and they come out of nowhere, actually. So what really does happen in a crash? Well, there are a couple things to keep in mind. Number one, everyone needs to calm down. It's not the end of the world, and if it is, and the Lord Jesus comes back, everything will be just fine. But beyond that, if we look at what's going on, there are two interesting things to consider. Number one is what is called the Plunge Protection Team, also called the Working Group on Financial Matters, that President Reagan put into effect as a result of the '87 crash. Now, the second thing to keep in mind are circuit breakers. They will kick in the course of the day. If the markets go down 7%, there will be a pause. 13%, another pause. 20%, another stoppage. That's to calm the markets down and to stop the idea of a free fall. Now, the Plunge Protection Team has been alternately considered a team of people that goes in and tries to prop up the markets. That hasn't been proven, of course, but that's what people think. They certainly work with different agencies, the different stock exchanges, things like that, to figure out what the root cause is. It may just be a technical issue that causes the market to go down, not an external event. And so they need to find out what that is and resolve it. But again, the idea there is to calm everyone down, make everyone think, reset where they're at. Again, these are opportunities. Don't think of them as giant negative events, but opportunities to make money in the future. You don't want to run away from the markets. You want to be ready for them. You want to anticipate that there are going to be issues, surprises, things that you never considered. And no one considered, for that matter. Did anyone see a pandemic coming? Did anyone at any moment think that we were going to war with Iran? All of those different things can happen, and they will in the future. Mistakes will be made. The Federal Reserve made a mistake in 1932 by raising interest rates. We had, of course, the disastrous effect of inflation in the early 1970s, where instead of raising rates, they lowered them and just made inflation even worse, which of course caused the interest rates to have to go much higher in the early 1980s, up to like 20%. These are all mistakes by people, not necessarily intentional. They're trying to do a good thing and do the right thing, but mistakes do happen. And you need to be aware of those and handle those. So I hope this is being helpful to you. I hope that you consider what I'm saying, because somewhere in time, the markets are going to go down. Maybe, as the word is, bigly. But you're going to have to be ready for that. Like I said, if you're concerned a great deal, put some money aside and wait for the opportunity to come to you. Even Warren Buffett has that, but that doesn't mean he's totally out of the stock market. He isn't. He has a large amount of money in cash and treasuries, but he's not totally out of the stock market. So I hope you found this helpful to you. I hope you revisit this again when times get a little bit rough out there, to calm down, think more clearly, and consider the possibilities that are before you. I hope you like and subscribe to this channel and share this with others that could benefit from this. And I hope, as always, that you remember the question, to invest or not to invest. That is the question. Good day.